And to unpack what we got from the Federal Reserve, we've got Stephen Blitz, chief U.S. economist at TS Lombard. Stephen, thanks for your time today. So a December rate cut now uncertain. Markets seem to be spooked by that. What do you think will get up ahead?
Well, I actually think they're probably not going to cut in December. As you said, it depends on the data. But I think given the run of data that they're seeing, sort of unofficial data, you mentioned the state collections of unemployment claims. I doubt very much between now and mid-December, when the next meeting is, there's going to be such a dramatic shift in the data that he's going to come in and cut. So I think it's he's holding. He's not going to actually say he's holding because there's always that possibility. But I think there's no cut mid-December, and then they'll revisit it again at the end of January when we know what the holiday sales are.
Yeah. So you talked about the importance of having data, but then this is all happening at a time when the U.S. government is shut and there is no official data, not a lot of official data. So how do you think that is impacting the potential pause in December?
Well, I think what's impacting it is something that the Fed is really going back to the 07, 08, 09 recession, that they found that at turning points, data normally lags just by virtue of the process of collection and reporting. And that anecdotal data becomes much more contemporaneous and consequently at turning points much more important. And what he told us today is that the anecdotal data is pretty much where it's been since the September beige book. There'll be another beige book mid-cycle before the next meeting, and we'll see what that says. And I think that beige book number will probably, or report, I should say, will go a long way to determining whether or not they cut again. But I think his presumption here is that it's going to paint a picture that's pretty consistent with where we are at the moment, and therefore no real reason to cut.
All right. And as the Fed, waits to see how the economy will unfold, does this kind of potential pause signal that they are now focusing more on inflation? How are they doing in terms of balancing their dual mandate to support growth and keep inflation in check?
Well, that is the balance. And I think the key word in everything you said is balance. I think the division is on the FOMC are those people who see an inflation problem, not an employment problem, and vice versa. And until the data begin to really decisively lean in one direction or the other, they're not going to do anything. Now, if the data stays where it is, namely that, real growth is not at the fore, there's oddball aspects of that. But if real growth is in like the 2.5% range, inflation is at 2.5, 3, and the unemployment rate is around 4.25, there's no reason for the Fed to do anything but stay where they are. And I think between now and the next 6 weeks, I don't think there's going to be a data report from either private or public sources, because I'm assuming the government's going to reopen between now and then, that's going to give them a dramatically different picture than that. And consequently, they will choose to punt at the December meeting.
Yeah, and the Fed will also stop shrinking its Treasury holdings. How will this affect, how will this balance sheet announcement affect the broader U.S. economy and financial conditions?
Well, I think it eases financial conditions, and I'm glad you asked the question because, we're all focused on this, so the markets, everyone's very focused, obviously, on the funds rate and the path, but they're going to stop buying, they're going to stop asking the market to buy an extra $5 billion of treasuries every month, and that's meaningful on the margin, and in addition, they said they're going to buy bills with the cash runoff from their coupon holding, from their Treasury holdings, and they're going to use the money from rolling off on their mortgage securities and buy Treasury bills as well. So what you get, and I think this is the important message, is that you get a little bit of a yield curve control light. Right, and we'll know this in a couple of days when Treasury gives us its refunding announcement. They're going to hold their coupon auctions constant, and they're going to raise most of the net new money at the short end in the bill market. The Fed is going to be a buyer of bills, so they'll be there to take that up with the end of QT and also the conversion of the runoff on mortgage securities into the bill market. And at the same time, by not increasing the coupon auctions, they're actually going. They, now being the Treasury, are actually going to create a little bit of a shortage. It's not dramatic, it's subtle, but in a period where you have economic stasis, it's interest rate positive and curve flattening.
Yeah, we'll watch that. Appreciate it, Stephen. Stephen Blitz, there, Chief U.S. Economist at TS Lombard.